Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Today we have Kyle Malmstrom, and he has a special guest, and that is David Gebhardt from Centara Legal Group. Gentlemen, how are you today?
Doing awesome. Thanks, Eric.
Doing well. How are you?
Doing fantastic. Kyle, you brought David on the show today. How did you guys start working together?
Dave and I have been working together for over 15 years, plus or minus a year there. When I got into the business, 2004, he was the estate planning attorney, or his group worked with Centara Capital, which was the original group that I joined. And we've been working with clients together for that amount of time.
Outstanding. How is it to work with him? No, just putting you on the spot there.
Dave's great to work with.
Well, that's always good to hear. David, I'll ask you the same question. How is Kyle to work with? Pretty good?
It's great. You know, there's few people that I've worked with longer than Kyle. So he's a great partner. He knows how to set up cases, how to gather information, and it's fantastic.
Right on. Well, what are we talking about today?
Today, we brought Dave Gebhardt online because there's kind of a hot planning topic that we want to discuss, and it's known as the upstream power of appointment. Another name for it might be the general power of appointment. It goes by a couple different names, and so we wanted to run through the mechanics of it and talked about the benefits of it and what the drawbacks are, basically educate people on how the strategy might apply to their life and how they can benefit from it.
All right. I've never heard of this, so I'm here to learn from you guys. Where do you start today with this?
Well, I think what we need to do is set up what it is, talk about the benefits so that people can grasp, okay, how does this apply to me? And then we can get deeper into the details of why and how and what and when and what are the risks and what are the problems that might come about from doing a strategy like this. It seems like if the setup is right, it's kind of a no-brainer for me and my clients, but it has to be the right fact pattern. So we want to identify that fact pattern and get that out there.
All right.
The general idea behind the upstream power of appointment is it's really about tax planning. And as you know, Eric, we do quite a bit of tax planning here, and Dave does a lot of tax planning with us. You have different taxes. You have capital gains taxes, you have estate taxes, you have gift taxes, you have income taxes, you have all these different taxes. This one specifically is going to apply primarily to the capital gains tax. There's some different taxes, generation skipping tax and things like that could apply. But for the essence of this conversation, we're going to talk about the capital gains tax. Okay. And this strategy is about how to get a step up in basis when someone else passes away. So, Dave, do you want to give us a quick rundown on what a step up in basis is and what that means so that our audience understands what we're talking about here?
Well, sure. So in tax, when you purchase an asset, whether it's real estate or stock or anything like that, it's going to have a cost basis, meaning the amount that you paid for it or the amount that's been contributed over time, less depreciation. And then if you were to go to sell it, then the tax that is due is the difference between those two numbers, the difference between what you paid for it and what you sold it for. That's the tax on capital gain. Mm-hmm. A step up, this was a rule that was instituted, almost a century ago, where if you hold an asset when you pass away, that asset gets a step up, meaning the cost basis goes to the current market value rather than the existing cost basis, so that your beneficiaries, your heirs, do not pay a capital gain when they sell it, or it gets a new depreciation schedule if you keep it, that type of thing.
Okay.
The capital gains tax rates, are 15% for the vast majority of the public, but for our high net worth clients, anybody making over $250,000 as a married couple is going to pay 20%. But then they're going to pay 20%, and then they're also going to have the net income investment tax, which a lot of people know is the Obamacare tax, which is another 3.8%. That's over the $250,000. And then you're going to pay the state of California tax, which if you're making over $1 million here is another 13.3%. So all in all, you could get close to 40%, just a little over 38% here in the state of California if you sell something.
Ouch.
Yeah. So an easy example of cost basis, just to get everyone's head wrapped around it. Let's say your dad buys a stock in 1990 for $10,000 and and it appreciates today to $110,000. If he sells that stock today, he's going to pay tax on the $100,000 of gain. But when he passes away, what Dave was talking about was he gets the heirs get a step up in basis at the date of his death. So that $110,000, which is today's market value at the time that he passes, is the new basis for the stock. So the heirs have the opportunity to sell that stock at 110 grand and not pay any tax, which is huge, right?
Yeah.
But for most of our clients, waiting until they die doesn't benefit them. So that's kind of the idea of the strategy: is you don't have to die to get the step up in basis.
All right. So how does it work?
Let's talk about the benefits of the strategy. I think that's a good place to start. So Dave, when we're talking about, you and I work together quite a bit. So when we're looking at our clients' plans and putting it together, what are some of the benefits that we're going to get out of this strategy?
Well, I think a lot of the benefits are obviously tax savings, but also flexibility. So oftentimes, the client fact patterns that we usually see, clients in their 60s or in their 70s, they have an existing portfolio of assets that they've accumulated over their lives. And these assets are real estate or a stock portfolio, or it could be anything really. And those assets, their cost basis is what it is. It's, if they've got rental properties, then that cost basis could be very low because they've held it for 20 years. Or if it's a stock portfolio and they've got certain stocks, they bought Amazon when it was low, or they bought, these other stocks that were low and they've just held it for a really long time, and then their cost basis is low. And that tends to reinforce itself over time because it's hard to reposition when you have these low basis assets because it's painful. You have to pay that tax. So it tends to even compound over time. So you get more and more concentrated positions in these very low basis assets. And so that's what occurs over time. And so the benefit of doing a strategy, something like the upstream power of appointment trust, is it can raise those cost basis so you can reposition or use those assets or do whatever you please with them. It frees up a lot of opportunity.
I'd add to that in that, I first and foremost, second, the flexibility and optionality of the strategy. Anytime we're doing planning for our clients, anytime we can create flexibility, we're gonna be an advocate for that, and we're gonna be a proponent and say, hey, look, this is gonna create a lot of optionality for you. So one of the other things, Dave, that you touched upon was, let's say you have rental properties that have been depreciated for a really long time, and you got the step up. At that point in time, now you've reset the depreciation schedules, which could be, depending on the amount of real estate you have, could be $10, $20, $50, $100,000 in annual tax savings because you have a new depreciation schedule offsetting that income. So there's real tax savings in this strategy, Eric.
Yeah, it sounds like it. I mean, it's huge.
Hey, Dave, let's go ahead and tell everybody what we're talking about and how this strategy works, and then we can get into more of the mechanics of it. When we're talking about the upstream power of appointment strategy, what is it that we're talking about?
Well, I guess let me take even a step back. The purpose of a step up in the context of tax law, it's not often that the IRS will give you a benefit for nothing, basically. But the purpose of this was kind of a recognition of really two things. When somebody passes away, those assets could be subject to both estate taxes, and if they're subject to capital gains taxes, then that might be really punitive. It could be, the marginal rate gets up in the high 80s, 90% on a particular asset inheriting it. That's very difficult for beneficiaries. The other thing is if you inherit an asset, you don't have any of the records on that asset, so it's really hard to calculate that cost basis. So that's really the main reasons that the IRS gives us this step up when somebody passes away. So what we're trying to do is to capture this step up in a way that doesn't involve the client themselves passing away. Maybe we can use it if a trusted relative passes away, perhaps. So the first thing that's done is we set up a trust, and this trust has certain characteristics, and it grants to a parent, perhaps, an older relative who may have a shorter life expectancy than the client. It grants them special powers. It's called a power of appointment. And if that relative passes away with that power of appointment still in place, then those assets that are subject to that power of appointment get a step up. So now the client can do what they please with it.
So I want to make sure everyone understands that. So what you're saying is, in this strategy, we're going to use someone else's life, probably somebody that has a shorter than normal or a shorter life expectancy, probably less than 10 years for sure. Less than 5 years is probably ideal. And then when they pass away, you're going to get a step up because they had the power of appointment, which makes that included in their estate. Is that right, Dave?
That's right. That's right.
So thus, when they get the step up upon someone else's passing, then they have the optionality to sell. They can reset the depreciation schedules, kind of some of those benefits we talked about.
Now, the power of appointment, explain that just a little bit, because you're choosing somebody that has a lower lifespan, right, is what you're saying. How does that work with the power of appointment as far as ownership?
So I can field that. So technically, the IRS, when they measure things from an estate tax point of view, they want to say, John Doe who passed away, we want to measure everything that he owns so that we can accurately assess estate taxes. Mm-hmm. Now, they define what you own as what you own, or in some cases, what you control. And so in this case, what we're trying to do is give just enough control to the older generation, to the other individual, so that it's included in their estate from an estate tax point of view, and in that sense, gets a step up. So this is a way of kind of triggering measurement from an estate tax point of view so that we get that, side effect benefit of getting a step up in cost basis.
All right, that makes sense.
I think a case example might be helpful here. So we recently met up with a gentleman. He's worth about $40 million. He's in his 50s, and he's pretty affluent guy, very sophisticated guy, high net worth, high income, and he had made several private investments into Reg D Section 144 investments, private placement investments. And one of the investments that he had put money in, he had a home run on, and he originally put $2 million in it, and it grew to about $10 million. Now he has this $10 million asset that he really can't do anything with unless he wants to pay a truckload of taxes. And being a high-income earner, he's going to be paying close to 40% on that $8 million worth of gain. Unfortunately, he didn't meet us soon enough because his mom got ill, and she had a shortened life expectancy, and she passed away last year. And had he done this type of strategy, that $2 million basis would have stepped up to $10 million, and he would have saved the tax on the $8 million, call it $3 million in tax. Mm-hmm. So
wow,
all he has to do is give his, it's pretty technical, and that's why we have Dave on the line, but by giving his mom this power of appointment, the ability to direct where the assets go, he would have got the step up. So let's chat about that, Dave. So what does giving someone power of appointment mean?
So power of appointment, again, legal words are not our ordinary language. So power of appointment just means power to direct where assets go. So if you want to think about it that way, it could be that the trust document gives, trust documents give powers of appointment all the time for different reasons. But specifically for this, we're talking about giving, intentionally giving specific powers to an individual specifically to trigger this tax rule. So all we have to do is to make the power of appointment general. And I know that's, a pretty vague term if you're not familiar with the tax law. But general just means as opposed to a specific power of appointment. There could be all sorts of different powers one could give an individual that would make it general. It could be that you give them the ability during their lives to give it to anybody they choose, right? That obviously would be a power of appointment, a general power of appointment. You could give them the power only at their passing to direct it to, let's say, their creditors or their estate or to their heirs, let's say. That could be a power that we give them, and that would be a general power of appointment. So the idea behind one of these trusts is we would choose which of these powers we want to give them, which powers we trust them with over these assets, and we'd give them just enough to trigger this tax rule.
In layman's terms, you're basically giving someone the power to give away your assets, right?
Somewhat, yeah. So we can limit it, obviously, and that's in our best interest too. But one of the key things we want to do is when we're choosing someone to possess this power of appointment, we're going to want to have a very high level of trust in them because we are giving them authority over assets.
That was my next question. Is my concern is if someone is of the older generation, maybe there's some faculties that aren't as sharp as they used to be, or you give them the power of appointment, and then they still have a life expectancy of 5 years, but 3 years later they, their faculties start to fail a little bit more. Boy, is that a concern that they will give it to somebody else, or give it to a charity, or give it to a neighbor or something?
So that can be. So the way we limit the risks of these, we could do it in a number of different ways. So the first way that we do it is we make the power of, or the first way we could do it, I suppose, is we make the power testamentary. So in this case, that means that they can only exercise it upon their passing. So they can't, while they're alive, say, give these assets away. And this protects us in a number of different ways. So this, let's say it's your mother or your grandmother that you've given this authority to, and, they start, getting a little bit of dementia, and you think, they may not really be in the position to accurately steward these assets, and so I'm getting a little concerned. One could always undo this transaction while they're alive, and then there wouldn't be that risk of them doing that if it's just a testamentary power. Also, another case, this would be, they get interested in the pool boy and they think, we're going to leave a bunch of assets to them, then that would be a case we could avoid by making it testamentary. That way we would probably have some idea ahead of time that something like this was happening, and the risk would go up, and then we'd reverse this transaction.
Gotcha.
There's some other belts and suspenders I think you can put on those trusts, right, Dave? But in general, you need to trust this person pretty implicitly, right? They're going to have a lot of power. That said, we're going to talk a little bit about what could go wrong there, but let's talk about some of the fact pattern and factors that we need to get this strategy in place, because it's pretty case specific. And again, we spend a lot of time with our clients and we get to know them really well, so we're able to identify these on a pretty regular basis. But obviously our clients would need to have a low basis asset that they want to get a step up in basis on, and then they're going to need to have somebody that they could name or give this power of appointment to that probably has a shorter life expectancy than normal, because at some point you probably want to get this asset back. And one of the reasons we're talking about this today is because the Tax Cuts and Jobs Act that was signed December 19th, 2017, put a provision in there that made this strategy a little bit, it made a bigger net for it. And what we're talking about is the estate tax exemption. And so I want to make sure everyone gets this, because this is critical to the strategy. If you could mess this up if you don't get this right. So Dave, when we're talking about doubling of the estate tax exemption and this strategy, what does that mean? How does that play into this?
Yeah, so this is, I guess, a necessary component to make this strategy work. Back when the applicable credit was low and shielded, only a small amount, there wasn't a whole lot of opportunity.
Hey, Dave, what's the applicable credit, just for our audience here?
Okay, sure. So the applicable credit, this is a credit that shields a transfer of assets from the estate tax. So when one passes away, all of your assets could potentially be subject to estate taxes. And estate taxes, depending on the year, it's a pretty severe tax. The marginal rate could be, it's currently 40% is the highest, but the highest it's ever been is around 55%, I guess, in recent memory. So it's a tax to avoid if we can. Now, most assets that are passed, most estates aren't subject to estate taxes because of this applicable credit. This applicable credit shields a certain amount from the effects of estate taxes. So if one passes away and the total assets that one owns or controls is below that applicable credit, then there's no estate tax due. And if you're above that applicable credit, estate taxes are only due on the amount that's above that limit. So in the past, it's been as low as, let's say, 600,000. That was, say, 97 and before. It's been, it's bounced around all over the years. It's been $1 million. It's been $2 million, $3.5 million. It was $5 million, and then they adjusted it for inflation. So it's been a little bit higher than that. And then, this most recent law, it doubled it. And so for individuals, we're above 11 million now in this applicable credit. So it really is providing a lot of room to do a strategy like this.
Let's get clear here. If you're looking at, let's say you're G2, you're the client, and you're looking at G1, you're G1 generation 1. You're looking at mom to do the strategy. If mom's worth $20 million, is this something we'd be looking at?
I would say definitely no, because again, in that situation, every dollar that's added to mom's estate is going to be subject to estate taxes at whatever that marginal rate is. So if we do this strategy and save taxes on capital gain, even at, worst case scenario, say, 30-40%, and we're incurring it at estate taxes at 40%, or could be even worse. The 40% is actually quite low in terms of the historical marginal rate on estate taxes, then that's not a very good trade-off, right? We're not doing anything, we're not accomplishing anything, and we may be costing ourselves money if we add to that problem. So if generation 1 has an estate tax problem already, then this is not a good strategy.
The estate tax exemption right now is $11.49 million. So you need room there that you can give assets to the G1 person that you're nominating here, that they have to have room so that additional assets could be added to their estate so that they don't have an estate tax. So in an ideal situation, we see this pretty commonly. Somebody has 20, 30, $40 million as our client, and their mom or dad only has, or their parents combined have just a couple $1 million. So, if it's a couple, that $11.4 million is now $23 million. So there's a lot of room there, but it works better with one individual, I think, because you don't know when two people are going to die. So if there's just one person, you want them to have remaining exemption amounts so that you can give them this power, and at the end of the day, when they pass away and go to heaven or wherever they go, that the IRS comes in and says, okay, hey, even with these extra assets, they're not going to have an estate tax. And oh, by the way, here is your step up in basis. And then now you as the beneficiary get the step up in basis. Is that right, Dave?
Correct. Now, I don't know what you're implying, go to heaven or wherever they go. Obviously, if they're kind enough to do the strategy for you, they're definitely going to heaven, in my opinion.
That punches the ticket right there. Yeah, I'm pretty sure.
There you go. So yeah, no, absolutely. So if we change the fact pattern to where generation 1 doesn't have 20 million, let's say they only have 2 million, like you said, then yeah, I think that it provides ample opportunity to do a strategy like this where we could, transfer assets into this power of appointment trust. These assets are, in a sense, adding to generation 1's overall estate when it gets measured. But so long as we stay below that, what the applicable credit will shield, then we're still in good shape. So we get the step up, but we don't incur estate taxes. And that's kind of the sweet spot we want to be in.
So Dave, in that situation, let's call it $11.5 million of applicable credit or exemption, and they're worth $2 million. You could do $9.5 million in this strategy, but the Tax Cuts and Jobs Act sunsets back in 2026, and it's going to drop back down to $6.4 million. Let's just say you added $10 million to mom's estate. How do you protect against that sunset provision, provided she lives longer than 2026, so that you didn't give too much money to mom and now you're just going to get hit with estate tax?
Right. So generally what we can do in these trusts is we make the power of appointment contingent, meaning other things have to be true for that person to be able to exercise that power of appointment. So in this case, what we would do is we would say generation 1 can exercise that power of appointment only to a dollar amount of their estate less, or the applicable credit less the value of their estate. So that would be a way of, I guess, mathematically or in the trust document itself, limiting the negative impact of law changes on this applicable credit.
So you do a formula-based strategy that says, hey, this amount of money is what mom could give away, and that amount of money is equal to her estate exemption minus her assets. Is that right?
Indeed. And there's other things we can do too with how we fund the trust. Occasionally we can make it so the value of, the nominal value of those assets is less when reported on their estate tax return. So we limit the risk there as well.
Well, Dave, let's talk about the risks with this strategy, aside from the estate tax risk, right? You're giving someone quite a bit of power. So I often hear, when you present a technical strategy, something like this, most people want to know what can happen, what can go wrong, what can go wrong here, Dave? This sounds too good to be true.
Absolutely. So I'd say let's take the risks from most severe to least severe. How about that? That'll save our listeners time. So I think most severe risk is you pick somebody who is untrustworthy, right? And then they exercise that power of appointment in a way that you don't approve of. Okay, that's the main risk. And the way, again, we deal with that risk, that major risk, is you choose people that you trust implicitly. And if your trust is ever wavers in them, then you can just reverse the transaction and sleep easy at night again. So that's, I think, the first key is that you want to pick the right individual, and that's going to give you a lot of comfort.
Dave, is that like giving your mom the power, and to your point, she falls in love with the pool boy, and then she decides to redirect all your assets to the pool boy? Is that what we're talking about?
That's right. So, number one, we can, in the design of the trust itself, really kind of limit the negative effects of something like that, of a breach of trust or a power of appointment holder doing something that you would disapprove of by, we could make it testamentary. We could limit that general power of appointment to, the individual could only direct it to creditors of their estate or to heirs or something like that. So we could limit it in some ways to shield us from some of those unexpected negative consequences, so that if we did this strategy and then we did see mom carousing around with the pool boy, then we might say, okay, now's the time to switch this around, because this is now a different risk than I got in for.
Okay, that's the first risk. What's I think another risk is the creditor piece that you kind of touched upon that, Dave, and that is
absolutely. And I'd say that is probably the second largest risk, again, depending on the circumstances. One never knows, I suppose, whether there is a risk of creditors coming after an individual. But if you have a parent or another older relative and they're willing to do this strategy with you, then probably knowing what their balance sheet looks like is going to be key. Knowing what is likely to occur in the future as far as credit risk is going to be key. Really, older individuals, sometimes the major creditor risk would be like medical bills or something like that. They're not going out and flying an experimental airplane into a crowd or something like that. They're not engaging in risky activities that's going to cause a lot of liability in that sense. So it's really more about risks that they've incurred a bunch of debt, and you're going to be on the hook for that if it's unknown. But that's part of the reason that you pick who you pick, is that they're going to be a very low credit risk. So that's a way of dealing with that particular issue. There are some fancy things one can do with these trusts too, structuring them in certain states with specific legal provisions that limit the effect of what creditors can do and things like that. But these are relatively untested and fancier than we need them, because oftentimes we're not in that situation where we only have one person and they're a major credit risk, but we want to use them anyway. So that's not usually the case.
Kyle, it sounds to me like any opportunity for the person that you're entrusting with this to give it away or get it taken away, like you said, as far as maybe a creditor or something like that, those seem to be the biggest hurdles. Are there any others that we need to know about?
No, you're giving them a big power it's broad that they can do a lot with. You just probably want to be cognitive if you don't really have that great a relationship with mom and she has a soft spot for your brother who doesn't have any money. That might be notable. You probably also don't want to bind up the trust document and make it a coffee table reading document for people to visit and possibly influence mom and say, hey, look at this. Probably avoid that if you could. But generally speaking, our clients don't really have that big an issue, right? They have a great relationship with their parents. And again, it's all back to the fact profile, and it's back to the planning and the core of how we do what we do. And so for our clients, if they can come in and share the details of their life and share their family tree, and we put a family tree together for everybody that comes in, and we talk about all of these issues and we identify all the different opportunities, then Dave and I will have, if we identify this as an opportunity for someone, Dave and I will get in the same room with this person and we'll walk them through all the risks and all the benefits. And I think the benefits outweigh the risk by a long shot for most people. It's pretty case specific. Mm-hmm. Dave, you want to add to that?
Yeah, no, this type of strategy, if the facts are right, and again, the facts we need are generation one with limited life expectancy, generation one with space below their applicable credit, and a good relationship with generation one, and assets that are highly appreciated. This is just like a home run. There's not a lot of downside to it, and it can make a massive difference to the client in terms of tax, in terms of flexibility, in terms of safety of their assets. They can diversify out of concentrated positions, all of that. It can be very, very valuable.
So I brought this up to a client of mine 2 weeks ago, and he said, well, this kind of sounds like a hassle. And I'm like, this is not a hassle. This is 2 hours of your life to save. I think in his case, it was well over $1 million. And, he had identified his wife's mom was frail and probably had 2 to 4 years to go. And once I said, hey, look, this is a no-brainer. It's a couple hours of your life and you're done. It's like, oh yeah, we let's revisit that. And so we're going to proceed with that conversation with that gentleman for sure.
Yeah. If I can make $1 million in a couple hours, I'm all in.
Yeah, absolutely. That's what we try to do for our clients.
All right. Any closing thoughts for today on this subject? This was very robust.
No, just make sure you seek the right advice, right? Make sure you have people that have done this and they know what they're doing. It's a very beneficial strategy for a lot of people. I think the net is pretty wide in terms of who all it could benefit. One of the things I like about the strategy is you can tell pretty much anybody you know about it, and someone's going to know somebody that it can apply to. Mm-hmm. But most importantly, just make sure you get the right team. Obviously, I believe in our process here, and we can identify these processes, and we work closely with our clients' professionals, or you can choose to use Dave or whoever it is, and we can get it all set up and make a pretty big impact in your family's life. For sure.
Well, that was my next statement, is that this sounds like it has a tremendous amount of moving parts. Anybody listening to this podcast right now, if you're thinking about this and you're thinking, well, this may be something that I could do, obviously, Kyle's already said it. You've got to seek out a professional, and the professionals at Centura Wealth, that's who I'm advising you to go to. Kyle, how can they reach out to you if they do have questions about this or they want to meet and just discuss their specific circumstance?
You can find us on the web at www.centurawealth.com. I think my email is on the webpage. So any of those ways, LinkedIn, I think you can get to us a variety of different ways. It's not hard to find us.
Yeah, should be pretty easy. All right, guys, thank you so much for your time today. This was a great podcast. And for those listening at home, one of the takeaways is if you have a brother that is putting together, and I'm using air quotes, art with popsicle sticks, rubber, cement, googly eyes, and maybe plastic bottles, and your mom thinks that that's just the greatest thing in the world, maybe she's not the one you want to put the asset with. But think about what you could do. Think about the taxes that you could save and all the possibilities, because like I said, if I could make $1 million in a couple hours, I'm all over it. Again, I want to thank you all for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when they come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks so much for listening today. For everyone at Centura Wealth Advisory, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory, Centura, is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.